A stock does not have to double to put a short seller in serious trouble. Imagine you short $10,000 of stock at $100 per share. You post $5,000 of your own capital as margin. At first, this looks simple. If the stock falls, you make money. If the stock rises, you lose money. But the dangerous part is hidden inside the margin equation. Under a simplified 30% maintenance margin model, a rise of only 15.4%, from $100 to $115.38, can already push the account into a margin call. That is before the thesis is proven right or wrong, before earnings, before fundamentals, before the market comes to its senses. The math has already turned your opinion into a cash demand, and if the stock goes from $100 to $200, the loss is $10,000, but you only posted $5,000. So your return is negative 200%. Short selling looks like buying in reverse, but mathematically, it is not a mirror. It is a capped profit, uncapped loss, negative carry, margin-triggered position where other people's panic can become your execution price. A short sale starts with something that sounds impossible. You sell a stock you do not own. In practice, you borrow the stock first. A broker locates shares from inventory, from another margin account, or from a securities lender. You borrow those shares, sell them into the market, and receive cash proceeds. But those proceeds are not free money. They are collateral, because eventually you must buy back the shares and return them. That final buyback is called covering the short. The cleanest version of the profit formula is profit equals the number of shares times the original sale price minus the future buyback price. So if you short 100 shares at $100, then cover at $70. You make $3,000 before fees. But if the stock rises to $130, you lose $3,000. At the most basic level, short selling follows the same sell high, buy low logic as normal investing. It just reverses the order. But reversing the order changes everything else. Now, compare a long position and a short position on the same stock. A long investor buys 100 shares at $100. A short seller shorts 100 shares at $100. The long investor's profit is, the short seller's profit is. At first, this looks symmetric. If the stock falls to 50, the long investor loses $5,000 and the short seller makes $5,000. If the stock rises to 150, the long investor makes $5,000 and the short seller loses $5,000. But the symmetry breaks at the extremes. If the stock goes to zero, the long investor loses the original $10,000. The short seller makes $10,000. That is the maximum gross profit. But if the stock rises to $500, the long investor is up $40,000. The short seller is down $40,000. There is no upper bound on how high a stock price can theoretically rise. So the long position has limited loss and unlimited upside. The short position has limited upside and unlimited theoretical loss. This is why short selling is not just an opposite bet. It is a different payoff geometry. The payoff curve tells the real story. For a long position, the worst case is the stock going to zero. For a short position, the best case is the stock going to zero. That means the short seller's maximum gross gain is the original sale value. If you short $10,000 of stock, the most you can make before costs is $10,000. But the loss side keeps going. At $200, you lose $10,000. At $300, you lose $20,000. At $500, you lose $40,000. And this is still before borrow fees, dividends, trading fees, and margin interest. So the net short formula is not just, it is. Short selling does not only require the price to move in your direction. It requires the price to move far enough, fast enough, to overcome the cost of staying short. That is the first major difference. The second is margin. Here is the part most people skip. When you short a stock, you cannot simply take the sale proceeds and walk away. The broker holds the proceeds as collateral, and you must post your own margin. For a U.S. equity short sale, Regulation T generally requires 150% of the current market value for a short sale of a non-exempted equity security. In plain English, that means the full short sale proceeds plus an additional 50% margin deposit. So in our example, you short $10,000 of stock and deposit $5,000. The account begins with a $15,000 credit balance, but the short liability changes with the stock price. If the stock price is, then the liability is, your equity is, or now assume a simplified maintenance margin ratio of 30%. The account must satisfy. Solving that inequality gives, with, and so a 15.4% increase can trigger a margin problem. This is why being eventually right may not matter. A short seller must survive the path. That margin equation is a clean educational model. The real world is messier. FINRA's maintenance rule for short stock positions says that for a stock selling at $5 or more, the required maintenance margin is the greater of $5 per share or 30% of the current market value. And brokers can impose stricter house requirements. They can raise margin requirements during volatility. They can demand more collateral. They can liquidate positions to eliminate a margin deficiency. So, the exact margin call level depends on the broker, the stock, the price, the account, and market conditions. But the core math does not change. When the price rises, the liability rises. When the liability rises, equity falls. When equity falls below the required threshold, the position can be forced to shrink or close. That forced closing means buying the stock. And when many short sellers are forced to buy the same stock at the same time, the next piece of the system begins: a short squeeze. A long investor can be wrong for a long time and still simply wait, assuming they are not using margin. A short seller pays for time. The net profit formula includes borrow fees, dividends, and other costs. The borrow fee is the price of borrowing the stock. For ordinary, easy-to-borrow shares, the fee may be low. But for hard-to-borrow stocks, it can become extreme. The SEC's GameStop report gives a useful benchmark. From January 2007 to July 2018, the average lending fee was about 1.5%. But during the second quarter of 2020, GameStop's cost to borrow was greater than 100%, and in January 2021, it was around 25%. Now run the math. If you short $10,000 of a stock with a 25% annual borrow fee, holding the position for 30 days, using a 360-day convention, costs about $208, even if the stock price does nothing. Hold it for 1 year, and the cost is $2,500. So if the stock falls 20% over that year, your gross profit is $2,000. But the borrow fee is $2,500. You were directionally right, and still lost money before dividends and other costs. This is the negative carry problem. Short selling is not only a price bet, it is also a time bet. There is another hidden constraint. The borrowed shares may not be available forever. A securities lender can recall shares. If the short seller cannot find another lender, the position may have to be closed. That is recall risk. It means the trade is not fully controlled by the short seller. You can have the right thesis, the right valuation model, and the right long-term view. But if the borrow disappears, the position may be forced to close before the thesis plays out. This is why shorting is not just about analysis. It is about funding. It is about borrow availability. It is about operational plumbing. And that plumbing matters most exactly when the market is most stressed. Short interest measures how many shares have been sold short relative to a stock's float, and short interest can exceed 100%. That sounds impossible until you track the lending chain. A share can be borrowed, sold, bought by someone else, then lent again, then shorted again. The same underlying share can appear in multiple short positions, so the reported short interest can become larger than the float. This creates a dangerous structural feature. Every open short position is a future buy order. At some point, shorts must cover. They must buy back the stock. If short interest is low, that future demand may be manageable. But if short interest is extremely high, then a rising price can create a feedback loop. Price rises. Short sellers lose money, margin requirements tighten. Some shorts cover. Covering means buying. Buying pushes the price higher. That forces more covering. The crowd becomes its own risk factor. A short squeeze can be modeled like an algorithm. Imagine every short seller has a liquidation threshold. Some will cover at $110, some at $120, some at $150, some only when their prime broker forces them. Let be the threshold for short seller. Then, the forced buy-to-cover demand at price is. That simply means, if price crosses your threshold, your shares become buy demand. Now add a basic price impact function. This is not a full market model. It is a way to visualize the feedback loop. External demand pushes the price up. The higher price triggers some shorts. Those shorts buy. Their buying pushes the price higher. That triggers more shorts. The key insight is this. In a short squeeze, price is not only moving because new investors want to buy. Price can move because old sellers are forced to become buyers. That is why the squeeze is so violent. The demand is mechanical. GameStop is the modern case study because it compressed almost every short-selling risk into one event. According to the SEC staff report on early 2021 market conditions, GameStop short interest reached 122.97% of float in January 2021. For context, the same SEC report says short interest ratios for large non-financial stocks are often less than 2.5%, and for small non-financial stocks, they still tend to be less than 13%. GameStop was not normal. It was an extreme. It was crowded. It was expensive to borrow, and it became intensely illiquid. The SEC report says GameStop lending fees were around 25% in January 2021, after being greater than 100% during the second quarter of 2020, so a short seller was not only fighting the price, they were paying a large carry cost to stay in the trade. Then liquidity deteriorated. On January 28, 2021, the daily average relative effective spread for GameStop was 0.54%, 3 times the average of 0.18% for 2020. And on January 29th, when GameStop opened at $379.71, the median size at the best bid was only 19 shares. During the first 8 months of 2020, that number had been 4,720 shares. That is the liquidity lesson. The price can go against you. The borrow can get expensive. The margin can tighten. And the market depth can disappear at the same time. But there is also an important nuance. The SEC did not conclude that short covering alone explained the entire GameStop episode. Its staff observed that covering by short sellers contributed during discrete periods, but it was a small fraction of overall buy volume, and positive sentiment sustained the weeks-long price appreciation. So, the honest explanation is not, GameStop was just a short squeeze. It was a crowded short, plus retail demand, plus social media attention, plus high borrow costs, plus volatile options activity, plus thin liquidity, plus market structure constraints. The squeeze was part of the system, not the whole system. GameStop was not the first famous squeeze. In 2008, Volkswagen became one of the clearest examples of what happens when short interest collides with a disappearing float. Porsche announced it had effective control of 74.1% of Volkswagen. The German state of Lower Saxony held about 20.2%, so the simple float math was less than psi times percent of Volkswagen voting stock was freely tradable. But Reuters reported that around 12.8% of Volkswagen shares were on loan. That is the squeeze equation. Reuters reported that Volkswagen moved from a prior close of about €210.85 to an intraday high of €1,005 over 2 trading sessions, before closing at €945 on October 28th. And Volkswagen briefly became the world's most valuable company by market value. This was not just the stock went up. This was a market microstructure failure for the shorts. The shares they needed were not available in enough quantity at normal prices. When the available float collapses, price becomes the rationing mechanism, and price can move violently. At this point, it is tempting to frame short selling as purely dangerous or purely evil. That is too simple. Short selling has legitimate economic functions. The SEC describes short selling as a tool investors may use to profit from expected price declines, provide liquidity, or hedge risk in a related position. A market where only optimistic opinions can be expressed can overprice assets. Short sellers can help bring negative information into prices. They can expose weak business models, fraud, accounting problems, and unsustainable capital structures. The evidence on short sale bans is also more complicated than the public debate suggests. A major study of short-selling bans during the 2007 to 2009 crisis found that bans were detrimental to liquidity, slowed price discovery, and generally failed to support prices, except possibly for U.S. financial stocks. So the balanced view is this: short selling can improve markets, but short positions can destroy traders. Both can be true. A tool can be useful to the market and dangerous to the user. And abusive short selling, manipulative trading, and deceptive naked short selling are not the same thing as legitimate short selling. Regulation. SEO exists partly to address locate requirements, order marking, closeouts, and persistent failures to deliver. The real lesson is not moral, it is mechanical. You need to understand what the position forces you to do when the market moves against you. So the full short-selling risk equation is not just, will the stock go down? It is, direction risk is being wrong. Margin risk is being forced to cover. Borrow cost is paying for time. Recall risk is losing access to the shares. Crowding risk is other short sellers being forced to buy. Liquidity risk is discovering that the price on the screen is not the price you can actually execute. That is why short selling is not just the opposite of buying. A long investor can often choose when to sell. A short seller may be told when to buy. And that difference changes everything. The math of short selling is brutal because the position is structurally asymmetric. Your maximum profit is capped. Your theoretical loss is uncapped. Your time has a cost. Your margin can force your hand, and every crowded short contains future buying pressure. Short selling is not magic. It is not evil. It is a financial machine with very specific failure modes. This video is for education only, not financial advice. And this is Quantly, the math behind every market.